for my first question, you're a layman, you have a little bit of money, a few $1,000s. What do you do? How do you protect yourself?
Well, one of the consequences of the monetary policies that have now been pursued is, and that was the policy, that was the intention, was that they've driven the prices of all risk assets upwards. So that the real return, the prospective real returns on almost all standard, easily tradable assets are now pretty low. So the real return on government bonds, the highly rated government bonds, is 0 or near 0. In the UK-US case, the real returns are now about 0. If you believe that the central banks of Europe and Japan will achieve their targets, then the real returns on bonds in those countries vary between -1 and -2. So that's not a great investment, right? So the stock markets are very high. And it's a basic fundamental proposition which is very well supported by empirical work by Bob Shiller and others who got a Nobel Prize for it, that when prices are high, stocks are high, prospective real returns are low, not only because price-earnings ratios are high, but because prices are more likely to fall than to rise. So major equity markets don't look very attractive either. There are some housing markets that have corrected, so I think if you can buy some US property, I think that's been rather a good buy. In recent years, there was a brief period, no longer, just after the crisis, when British property was rather a good buy. That's why every rich person in the world seems to have bought a house in London. But that's no longer true. So I think the best you can do in the major developed countries is to preserve your capital, and you can't do that by buying bonds. You have to take some risk. Now, beyond that, then you're talking about special situations. And you have to pick markets correctly. There is still obviously great long-term potential in emerging economies, and it's if you're there's obviously some risk associated with them. That's what emerging economies mean, but they ought to return relatively well in the long run. But it's likely to be a volatile ride. If you look at the stock market indices for emerging economies over the last 20 years, they've been up and down. And property tends to be similar. You have to choose where you are, where you can buy, where you will. So the view I hold is average real returns on the major classes of assets now are extremely low. And if you want strongly positive real returns, you have to be prepared to take a lot of risk. And at the age of safe high returns is not the age in which we happen to live. I would love to be more cheerful about this. But that seems to me not only where we are, but it's of course where the central banks wanted us to be.
Okay, questions on the floor, please.
Center on Asia and Globalization, Lee Kuan Yew School. Thank you very much for your very comprehensive and brilliant analysis how global savings glut and global imbalances leads to crisis. I just want to ask questions pointing to two recent developments in Asia. And one is, as you know, the policy pursued by the BOJ, the qualitative and quantitative easing. Due to the policy, the Japanese banks have too much money, basically. And what they're doing now is coming to Asia, and in particular to Southeast Asia. What they're saying is that they can manage risks better. Okay, I'm not sure whether that's really the case. So what's happening is that the easy money from Japan is now flowing to Southeast Asia. That's the one recent trend. As a result, the mega banks in Japan are becoming the biggest syndicate loans providers in this region. That's the first trend. Okay. The second trend is, as you know, as we all know, that China has recently established a new infrastructure investment banks. And that's an attempt I would say, to channel the excess, the very high domestic savings into project financing in Southeast Asia and in Asia in general. That's again a capital flow from China to this region, to this part of the world. The problem is that the financial markets in Southeast Asia are massively underdeveloped. And if I listen to your story today, I do see a parallel of this recent development, how capital is flowing from Japan, from China to this part of the world, or will flow increasingly more in the future. My question is whether you see a potential of a crisis, and what's your advice to the financial regulators and watchdogs in this region? Thank you.
Okay, I think both observations are very perceptive and convincing. And it does remind me, but haven't followed the recent developments as closely as you have, of what happened before the Asian financial crisis, which was a very similar period, you will remember, in the mid-90s. And if I remember correctly, immediately before the crisis, Thailand had a current account deficit of 8% of GDP. And the Korean banks suddenly opened up to world flows and made some really quite astonishing investments. And then there was a reversal. And Indonesia too, and this led to a horrendous crisis, which was the worst crisis till this one. So I think what's going on is that the Japanese central bank, I don't think I have time to go through all the aspects of their policies, is deliberately creating a structure designed to weaken the yen and encourage capital exports. That's clear. That's
intentional.
Well, it's no, you will not find a speech by the Mr. Kuroda saying that's the intention. No, but it's a completely predictable and inevitable consequence of his policy, and the results are quite welcome, because one way for Japan, clearly, to raise inflation is to weaken the yen. In fact, it's the most powerful single tool, I think, and it's working. I mean, the yen is significantly weakened. And in this environment, it becomes very attractive to purchase foreign assets, and the hope that they will rise in price. And in any case, the return on domestic assets, I've already told you, JGBs are reasonably yielding 0.4%. Nobody in their right mind would buy Japanese government or any bonds in Japan. Even equity prices are boosted. So yes, this is going to happen. And I think it is clearly true that relatively small open economies, and compared to China and Japan, all economies here are small, are going to be overwhelmed by capital inflows. I expect there to be a round of emerging country crises in the next 5, 6, 7 years. I've actually more expected to be Latin America, because there's a lot of capital inflow has already gone into Latin America during this, and the reversals going back to the US are going to be very messy. So I've been thinking about what's going to happen in Brazil, particularly, possibly Colombia, possibly Mexico. In the longer run, the risk could happen here. I tend to think that though it's very, very hard to manage this, if I were in charge of an economy, thank heavens I'm not, I'm Indonesia or whatever, I would think very seriously about capital controls. I mean, the truth is you can't risk this. Certainly, they have to look very, very carefully, if they don't want to do that, at where the money's going and ask themselves, are the structures of wherever they're going, the financial structures, such that if it reverses, we could cope with it relatively easily. My previous book, Fixing Global Finance, had a lot of discussion of this and what some of the issues. And one of the most important is that you borrow in domestic currency. If you borrow in foreign currency, so if they're borrowing in yen, particularly to finance, or RMB, to finance domestic assets, you've got potentially a massive crisis in front of you. And I think people have to be very, very careful. But your description of the situation, this is where the next crisis will come from. And how China resolves its crisis now, and how far it resolves it through capital outflow of the type, is going to be immeasurably important for the world. And I think that's one possible outcome, that Chinese capital outflows will expand very, very dramatically. And it'll be very interesting to see how China manages that. It's something completely new for China. It's not something they've ever done before.
Next question. Yes.
Thank you. I'm Joshua Green. I'm a visiting professor of economics at SMU. First of all, thank you very much for your book. I've recommended it to all my students and encouraged them to watch your speeches online. My question is as follows. I took away as one of the things in your book that you're very anxious about central banks trying to reignite demand basically by pumping more money into banks and then having the hope that they will again lend it out, which could lead to another big credit bubble. So my question is, can you comment on two alternatives? Say a little bit more about programs for big debt restructuring, in particular for households, and secondly, a little more about the helicopter money. And I'm asking because as one who does not know all the laws, by all means, it could be that a lot of central banks don't have the authorization, for example, to stick money into household bank accounts, which might be a way of offering helicopter money. So any observations you have about those two alternatives would be much appreciated.
Yeah.
Thank you.
I think...
Martin, before you answer, since you're running out of time, can I just take the last two questions?
Yeah.
Then you can maybe combine the answers.
Okay.
Please, there are two more questions, so because we're supposed to finish at 6:30, so...
Okay.
I spoke too long. Apologies.
Yeah.
My name is Asha Hemrajani. I have two short questions. I wanted to, you presented on your summary slide and in one of your earlier slides, you talked about possible solutions. But how can that sound economic thinking that you mentioned, can that be translated into practical political actions, become operational politically? I wanted to know your views on that. And well, in relation to that, how they can be implemented by politicians who may have vested interests? That's my first question. And the second question I had was, you briefly mentioned earlier in your remarks that you had a set of rethinks between your previous book and this book. I'd like to know a little bit, if maybe you could focus on three different areas of rethinks that you had. That'd be great. Thank you.
Hi, evening, Mr. Wolf. I'm Wei Long. I have zero economic credentials, but I do feel guilty for not doing enough to charity. My question is on basically inflation targeting, be it Abenomics or otherwise. Because, when you increase inflation, you're basically telling people that their savings are zero. There are two options of this. One, they invest in some equity, which makes the equity market more reckless CEOs, richer, whatever, inequality increases. And from all of that also is retirees get poorer because their savings are diluted. The result, ultimately, down the road, kicking the can, is going to be a big blow up in government welfare spending. And with greater inequality or greater instability. On the nice side, we have people doing Occupy Wall Street movements, which are very kind and courteous, so be it in Hong Kong. On the wild side, we have ISIS, and this is going to be a big problem. So I cannot understand what's the point of inflation targeting if in future the result is going to blow out in our face. Thank you.
How do you defend inflation?
Okay.
Okay, you got some very good questions.
Okay, I'll try and do this in 4 minutes, and I apologize. I apologize.
Make it 5. I'll be generous.
Okay. I just wanted to cover the range of the book and to get people interested, because really the arguments you have to read through and work through yourself. I think debt restructuring I think it would have been relatively easy, but it is now relatively easy. There was a huge legal problems and political problems, notably so in the US, when this proposal was made. When the idea of debt restructuring was first floated in the US in 2009, it led to the creation of the Tea Party directly, which is, I thought it was astonishing. I still can't get my mind around it, that the great popular protest is that they were restructuring the debt of poor households who clearly couldn't repay, but nobody really complained about, not really in the same way what was being done for the banks. It's just amazing. But in theory, at the point at which all of our countries were providing huge funds to the banks to recapitalize them, they could have said the quid pro quo is a process of restructuring underwater mortgages. And the best way to have done that, in my view, would have been to have a program, I don't discuss that in this book adequately, in which some part of the debt was simply converted into equity owned by the banks. So the equity was shared between the banks and the household, and the mortgage per se was reduced to something that was affordable. And the desirability of this is that we know that if people are forced into foreclosure, there's a huge loss of value. It's actually in the interest of people to do this. Now, that, of course, means changing bankruptcy procedures and encouraging this. It's what they did, actually, interestingly, when saving the motor car industry in the US, but didn't work in the same way for housing. And nobody outside the US really did this at all. And that means that all the households are left still with their debt in Spain and Ireland, and that is a tremendous drag. So I think that the right thing to have done was, as a quid pro quo for the support for the banks, was a clearly defined program of mass restructuring of debt. Now it's very late. A lot of this has happened, but in some European countries, I still think it's quite a high priority, and something they could consider or could have considered as part of this bank restructuring they're now doing. Helicopter money. The simplest way of doing this would have been to say, and I made this recommendation, terribly unconventional nowadays, is that the government puts forward a huge investment program financed by bonds, government bonds, and sells them on the market, and the central bank buys them. And the point about this is compared to what we're now doing. What the central banks are now doing is creating a staggering amount of money in order to manipulate asset markets. That's essentially what they're doing. And to get that to affect income and spending, they have to do an immense amount of asset purchase in order to change income and spending, which is what they're really trying to change. What they're trying to make is people spend. And they do it indirectly by changing asset market values. And one of the most clearest facts about our economies is you need immense, and I do discuss this in the book, amounts of asset price manipulation, raising asset prices, to get relatively small amounts of additional spending. So my argument is, why not do it directly? And the way you can do that is, instead of supporting asset markets, you do the deal with the government of spending. So to take the Japanese case, instead of printing 80, I can't even get my mind around, 80 trillion yen to buy JGBs, which yield not much. JGBs and money in Japan are virtually perfect substitutes. They're not going to achieve very much this. They could have done a small fraction of the 80 trillion and simply said to the government, run a deficit of 15% of GDP for the next 3 years, we'll buy those bonds, and they would end up with less bonds. Right? They would have much less bonds, and there would have been a lot of spending. And the simple sentence, in Japan, they've already built all the bridges to nowhere. The simple way to do this is not to raise taxes, but to cut them. And raising the consumption tax was mad, because the one thing they need in Japan is more consumption, not less. So that's the way I would have done it. How would you translate this into operation? The policy system is not very open to new ideas, for two reasons. It's not very imaginative. There's a traditional way of doing things which is the right way. Everything else is unsound until you finally realize it's the only sensible way. And people only change their policies in a fundamental way when it's obvious they're failing. And the policies they've introduced this time, they were better than the 30s. We've done much better than the 30s. We haven't had a Great Depression. But the policies they worked this time have worked well enough to stop complete collapse and not well enough to get a real improvement. But that has not been sufficiently disappointing to force people to a reconsideration of the policy system. We're still basically using the policy system I've described. I've argued in my book, the way I think about this, which is I think the way much better people than I have in the past, is you put forward new ideas, you argue for them, you get them into the public realm, you hope people will read them, and so the next time round we will be prepared, more prepared. People will be more aware of the possibilities. But I don't expect any, the amount of groupthink in the policy system is staggering. And to some degree, the very fact that everybody's talking to everybody else in all these G20s and APEC and in Basel on the regulatory system means they're all forced to agree to do essentially the same thing. And once you've all agreed to do the same thing, nobody dares to do something different. The one real innovation in this, I think, the real innovation was the Americans are always the most willing to do what they think once they get themselves organized, because they really don't care what anybody else thinks. They're the one country who really doesn't care. So the stress test system, which Tim Geithner introduced in 2009, was astonishingly, and to my mind, surprisingly successful. And everybody else has since adopted it as a way of really getting to grips with the financial sector. And though this didn't solve the demand problem in the US, or the inequality problem, it did solve the question remarkably quickly of whether people had confidence in banks. They got that fixed. And it was because there was a policy innovation, and then something new has happened. I think one of the most important things is to try to encourage government, and I have this in my book, to do things, to experiment. Not to do all of them the same thing at the same time. And I think very importantly, perhaps the best, Kishore will love this, the best lesson for emerging economies from this whole crisis is to realize that the developed countries do not know what they're doing, because they don't, and to think for themselves. They have, by now, a vast number of very well-trained economists and policymakers, and they can think it out for themselves, and they can take it for granted that what we're doing is likely to be a mess. What have I rethought? The most important thing I've rethought, because I hadn't really thought about it rigorously enough before, is the link between macroeconomic developments and the stability of the financial sector, and the capacity of the financial system to generate debt, leverage, sort of more or less without limit, and then blow up. And I have a large chapter which discusses my different ways of thinking about that. But I think it's so I won't discuss three. That's the single most important thing I have learnt. And that leads to some very dramatic conclusions. Finally, on inflation targeting, well, I don't think it has all these terrible consequences. I think the idea that inflation targeting would lead stability on its own was obviously a mistake. It's quite possible that the target we have given was a mistake. But the idea that people should be able to foresee to some degree the value in money over time seems to me pretty indispensable, because the provision of money is perhaps among the single most important functions of governments. We could change that, but basically the provision of money is a function of governments in the modern system, and they need to be disciplined in doing it. And inflation targeting is the least bad mechanism I think we have to discipline it. I'm not personally in favor, though lots of people are, of going back to the gold standard. We can have a long discussion of why I'm not. I do discuss it in the book. And I don't think we can go to world money, because I think the Eurozone experience has clearly demonstrated that money is a property of a sovereign state. It's linked with a sovereign state. So having an independent central bank that targets inflation is not a bad idea, as I would have probably a higher target now myself. But what we've got to get away from is the idea that just because we've got targeted inflation successfully, we will therefore have a reasonably stable economy. That view is, we now understand, I think, clearly wrong. And that, I think, covers more or less those questions, and I only ran over a few minutes.
Well, I'm sure you will all take away many lessons from Martin's remarks today, but I hope you'll at least take away one important lesson, that more crises are coming. You need better policy makers, and therefore you need to support schools of public policy. So, thank you, Martin.